So we will be doing a short introduction on what controversy themes you would be looking at, but also what is the definition of an intangible. I think that that will be different for different people and people with different backgrounds.
Good afternoon, everybody. Yeah, I would like to start with maybe something that you would consider basic, but I think it's important. So what is an intangible? I think all of us would have an answer to this question, but we would all have a different answer. And that is because if you look at intangible as a professional, you can act as an accountant, you can act as a consultant, you can be a lawyer, and you would all have a different definition and you would all be right. And to avoid that, quite some time ago, Steef created this matrix and called it Ipr Matrix. And what it helps to see is that in every sphere you have a different definition, and that has a label. So for example, a patent or a brand or a trademark, it's identification. You see a logo and then you recognize that this is the brand. It's the ownership question. So who is the owner? And that can be a registration, but also can be the identity functions, as we know in transfer pricing. And last one is valuation, which again can be different from perspective of different professionals. And depending on this answer, you would either say that something is intangible or not an intangible. And when it's all in isolation, that sounds so good, but in reality, you constantly have clashes between these definitions. And my simple recent example is I was doing an analysis for a very straightforward limited risk distributor, which doesn't have any intangibles, is not supposed to have for me as a transfer pricing professional. However, what happened when I looked at the balance sheet of this company, it said intangibles and quite a big amount, which I was really surprised. And I started asking questions to the client, like, yeah, you should not have intangibles, right? And what it appeared is that for accountants, goodwill was an intangible, and this is what they put on the balance sheet and documented. And yeah, then the auditor audited it and put a stamp on it. And they agreed that this is an intangible. And they did not put any further explanation. They just said intangible. They didn't say what is it exactly. So only after asking the question, what is it? A goodwill. Okay, so from transfer pricing perspective, according to recent guidelines, if the goodwill is not tied to any other intangible, then it's not an intangible. So we're still good back to our limited risk distributor. But this kind of situations, yeah, they happen a lot. And also, for example, when you have a clash between tax and customs or tax and antitrust lawyers, you definitely would have similar situations where you would consider something intangible and the other professional not. And also you can have, yeah, controversy about how to value it and if it has value at all, for example. So yeah, I guess this kind of situation all of us have seen in professional life, but I think it's good to remember that when we will be going for our today's discussion, that it all starts with definition.
The bankruptcy is sometimes very hard for people to understand, but there's the Nortel case where Nortel went bankrupt, and there was a whole dialogue on which intangibles belonged to which shareholders. There was a European group of shareholders, an American group of shareholders. So there was a whole court case about what intangibles belongs on what balance sheet with different shareholders. Antitrust, the Microsoft views of their intangibles in the antitrust case in the EU is an example. Typically, IP law is the very narrow definition of intangibles. All of these have in common that they all use the 4 functional variables. So they all give it a label. They all can explain how to identify it. Typically, we call intangibles as hard to identify, but just one example is a swoosh on a Nike shoe, or if you go into a laboratory and there's a secret code before you enter, then you know behind that there's probably something people want to protect. Ownership definitions do vary quite widely amongst these 6 different disciplines. So as Maria already indicated, if you start a discussion with anyone on intangibles, you need to agree which of the 24 boxes you use as your starting point, because very much otherwise you will be lost in translation. So there's 4 functional variables, there's 6 disciplines, just as an illustration. So if you don't agree, if you meet someone on the street on which box you will use as a starting point, there's a very high likelihood you use the same terms, which means something different, or you use different terms, which means the same. So this is the lost in translation game when you talk about intangible.
So the second point, which I would like to talk about again to set the scene, is that once you agree on the definition of intangibles, you also need to see how it fits within several dimensions. And the first dimension is your holistic total value chain. The second one is your transactional, so very narrow view on the intangible. And the third one can be the valuation. So to give a more specific example, if you think on this picture of a brand, so you definitely charge a royalty for this brand, so that's the transactional view. And the percentage that you charge for the royalty should fit within the total value chain. So you cannot charge, let's say, 15% for the brand, because then it would eat up the whole profit of the value chain, but you only should charge something that fits within the total profit, and then remunerate basically the value that this brand creates. And secondly, you need to see that if you do evaluation, how the value of the brand that you determine, how it ties to the multiple years of income, in the term that if you value it too high, and then it's maybe more than the value of your total value chain, or even the value of the total enterprise, that of course doesn't make sense, and then the evaluation is probably wrong. So then you need to take this into account, and you need to see how it ties together. So once you have this 3 dimensions, matching and linking, then you can more or less rely on the numbers that you got, and then present it for the tax authorities, for example.
Yeah, if your value chain, your whole value chain makes 10%, and your brand makes 5, so half of the income you're making is allocable to your brand. That's one position. That's the top position, as you indicated, Maria. Then if that 5% is a percentage of sales, and you earn that income over multiple years, you can do a discounted cash flow, and suddenly you have a brand value. And I think the essence, what we see is sometimes people start with just throwing cash flows on a spreadsheet and do a calculation without putting it in the right context, and that leads to all sorts of discussions. One of my clients recently did a valuation and came up with 50 million of value, while their market cap was 60 million. Well, then you have a certain ratio you need to take into account, and then basically if you come up with a valuation of 50 million and the whole enterprise is worth 60, then obviously all the other elements of activities you're doing are only worth the 10. Well, is that a realistic proposition? So putting things into also quantitative into the relevant perspective, I think, is what this slide is indicating. Moving on from what we saw in the introduction, that the rules for for offshoring until the end of 2015 were quite different and much more legalistic of nature. And as Hans just explained, the legal approach is still being applied by tax inspectors in many, many countries. Although we see the OECD and the US in particular moving to a more holistic enterprise version where transfer of IP together with workforce and other features being seen as an enterprise-wide transfer, and therefore the value obviously goes up if you apply that new set of rules in the 2017 guidelines as well as in the 2017 US tax reform. So this is a case I've been working on where actually this is the introduction. So what I just said, up to 2015, lots of companies moved their IP offshore, Cayman, Switzerland, Singapore, Malta, BVIs. And as of 2017, due to change in legislation, and basically the change of legislation was a little bit the government's trying to close their back door. If something moves to Ireland for 20, while the enterprise value leaving the country is worth 100, then obviously you're missing 80 as a government, so you want to close the back door. A question I have for Hans and Mukesh to comment on is the playing field on international tax principles the same for offshoring versus onshoring? What do you guys think? So are we talking about the same framework, but then in the reverse?
Yeah, well, offshoring, as you described, if I remember in the past, I investigated the Google and the Starbucks and the Apple situations, and with all kinds of co-sharing agreements and further development, etc., etc. It was quite complex. What you see now is the cases as I see them on my desk, where I have to opine. It's often, I didn't do Uber, but I did do a few other companies where they were located in an offshore situation, and the whole corporation transfers its seat to the Netherlands, or sometimes the IP is being sold to the Netherlands. In the first situation, there is no exit tax in the offshore. The second situation, there is no capital gain tax on the IP. And the question then is the asset in the Netherlands depreciable? If you transfer the seat you have in the Netherlands, the issue that it's not going to work because, yeah, you can get a step up, but that's even more difficult. The easiest thing is, in those situations, probably the sale of the IP. But they actually, what I see happening is that the price is being made by the company. And the question is, how is this going to work? Well, there won't be an exit tax in the offshore, and probably is depreciation in the state where you go to. In the Netherlands, it's still possible to do onshoring, still. I'm not sure how long it's going to take. But yeah, that's a little bit what I see happening at the moment.
Thank you, Hans. I just will make one brief comment. There is nothing in the law as such which differentiates between the offshoring and the onshoring model. So second, as far as the offshoring of the IP portfolio is concerned, on the second part, which is use of the DCF method, Seema worked on a very interesting case on Sun Pharmaceuticals that I would like her to talk about. Before that, just a brief comment. There have been some cases in the context of intangibles, that have been a subject matter of dispute in India. In fact, the largest case on intangibles is now before the federal court, specifically on marketing intangibles, specifically with respect to intangibles in the context of marketing functions. There is a case of L'Oreal. In L'Oreal's case, the transfer pricing adjustment on marketing intangibles was predicated on the fact that as a distributor, it incurred more than its fair share of advertising and marketing expenses. Interestingly, the revenue took an alternative argument on DEMPI functions being performed. The court in turn took a very legalistic view and said that the contract between the distributor in India and the foreign associated enterprise did not reveal that any such DEMPI functions was envisaged to be performed by the Indian company. Neither was there any evidence that the revenue was able to bring to demonstrate that there were DEMPI functions. So that's a very interesting case, decision by the Mumbai tribunal. But I just thought I'll, seek Seema's indulgence to speak about the Sun pharmaceutical case, which entailed a Netherlands IP company and an adjustment with a US subsidiary. Seema?
Yeah. Hi, everyone. Hello. So, yes, I think in India, it's when it comes to controversy, it's more in the context of offshoring, where we see increased attention from the revenue authorities. In the context of Sun Pharma, which Mukesh was talking about earlier, so what happened is that it was a pharmaceutical research company. They transferred some IP to the Netherlands company during the development stage, and it was the abbreviated new drug application at that stage, and later on it became a very valuable thing. When it came into assessment, the tax office did something really weird. So what they did is that obviously once the intangible was offshored, the Indian company continued to act as the contract manufacturing center. And then the tax office came back and said that this entire thing was a business restructuring. And I'm going to look at this holistically. I'm not going to look at the transfer of the intangible separately, but I'm going to look at what profits this entire thing earned and do a profit split method. So what it did was it combined the profits that the Netherlands company earned with the profits of the Indian company and made a huge adjustment. The tribunal relied on the Vodafone ruling. They said that there is a legal entity concept which cannot be disregarded, and just because it's giving benefits to the associated enterprise, as long as the transaction of the intangible transfer was at arm's length, that's where the matter ends. And they treated the contract manufacturing as a separate activity, benchmarked it using the transactional net margin method. It was very interesting just to to think that they would think like that and go back, and there was a similar case of DQ International where on identical facts almost the tribunal had the same view that the transfer of the intangible, once it's done and it's proven to be at arm's length, there's nothing further to that transaction.
Yeah, it sounds like the legal arguments are prevailing in the case and honoring the contract and is addressing all the other value drivers, so to say, which are less legally protected or protectable, try to capture that in some kind of residual profit split type of metrics. So that's how it feels like. So it's a little bit a hybrid between a pure legal approach and the enterprise-wide economic approach I was referring to.
No, absolutely. Unfortunately, the Indian practice is a legal practice. The entire transfer pricing field in India is more law and legal driven. It's not really driven that much by economics. So that's the sad part of it.
I would call it that. I would call it, as we just learned, different governments go through different stages of awareness, and sometimes that means they move more to the economics, and sometimes it means they move back to the legal interpretation. So good or bad here?
I think, Steph, that and I can speak about it for India, that there is a tendency on part of the tax administration to put out international concepts and carry out adjustment, whether it is in the context of marketing intangibles or locational savings, but without a deeper understanding of whether there is a mandate under the domestic law to undertake those adjustments, and two, inadequacy of what's happening in the international space. As a result of which, the courts have been striking down all such adjustments on the ground that either legally it is not tenable under the law or the evidence was not there on record. However, I see that these adjustments or these forms of adjustments will become more serious when the revenue is able to work over its limitations on bringing evidence on record and as the international policy evolves further. So I think that these cases, as it seems today, may have been in favor of the taxpayers on legal grounds, but I see in the future the courts will rely more on what evidence is brought on record, and if the administration does a smart job, I think the taxpayer has a real risk on some of these adjustments.
Could be indeed. Yeah. Yeah. What I see here is that I still believe we have a very sophisticated tax administration in the Netherlands, but I have in another situation where IP was brought over from the Netherlands to another country, and in that situation, yeah, they use the tax administration use the DEMPI functions for the valuation, but actually never ever goes into valuation at all. They just stick to the point: how many people work there, what are the functions, what are the profile, which risks are being taken, etc., etc., etc. So that's what I tried to say in the previous session. That's also here is still very legal and not very economical, but it's clear that also in the Netherlands is going to change soon. More and more, the courts are going to hire people with an economical background to help them to understand what's really going on. And that's, of course, the first step to a new era of cases. And therefore, you have to make sure you have to try to prepare your clients for those kind of new steps. Because if everybody relies, the tax director, the tax inspector, the judge on legal principles, is going to be more or less an easy case. But if it's going to be in a new era, then yeah, be prepared. That's, I think, what I could say to this. Yeah.
Very interesting. I think different views, different stages of awareness and or unawareness. I think we're looking at. Next slide, where we have a case at hand where a Dutch company holds shares in two entities, one in Malta and one in India. Malta holds as a nominee holder, so IP law, very much legalistic, the rights to a technology platform and a brand. But India and Holland is where most people were on the payroll performing the DEMPI functions pre-IPO. Now, post-IPO and post-BAPS and post-US tax reform and etc., everyone says, well, maybe Malta is not the right holder of an IP, so let's move it onshore and let's take the charges, this technology platform and brand, allow Malta to charge to all the group companies, say 5% of turnover. Let's make a discounted cash flow valuation on that, which generates value, fair market value of 100 million. The next thing we were discussing with this corporate and a few advisors, can we transfer from Malta the IP to the Netherlands, where the core of the DEMPI functions and the lead of the DEMPI functions, the guys who run the technology and legal stuff on the platform and the brand, can we move it to the Netherlands for the 100 million? 100 million again being the 5% on sales projected into the future minus DEMPI cost. Whereas a nominee holder position, so someone who's mostly involved in the P of DEMPI would in this particular case only be able to claim 5 million, at least 5 million contribution to its role in the whole case. So I'd like to open the floor for the panelists. What are the consequences of a case like this?
From my perspective, it's comparable to mentioned before. Though the valuation issue is, if I see this case correctly, as you describe it here, there is IP on Malta, but actually there is not that much in Malta. It's been carried over there, it's been used there, and so whenever you bring back IP from Malta to the Netherlands, and you would like to capitalize it at 100 million in the Netherlands, you actually bring over much less than that, and with all due consequence for depreciation in the Netherlands. I haven't seen that discussion yet. As said, the situation I was involved with, I was asked to opine mainly on the question whether it's possible still in the Netherlands and what it does with DAX 6, the mandatory disclosure rules. But there hasn't been a discussion yet on valuation. And if I see this, Steef, I think in many situations, not in a lot of situations where IP has been carried over in the past, it will be done this way, where the company holding is based on corporation law, corporate law, where the company holding the IP, or possessing the IP, is not the company actually performing the DEMPI functions. And then you get this specific situation where legally speaking it's possible, but practically speaking, economically speaking, there is a discussion here on what you actually bring back and what it does mean for your tax depreciation in the Netherlands for the future.
I think good point. Holland paid part of the DEMPI functions, obviously, is paying again for the same rights it might have created before, quite a substantial discounted cash flow value when it wants to become the full owner, both in legal as well as economic terms.
But you said that some of the DEMPI functions were performed in the Netherlands already previously. So from a DEMPI perspective, what is in Malta is probably not the real value of the IP, is much less. So if you would indeed, you already have carried the cost of the people dealing with those functions in the Netherlands, and then you would bring it back for the full value. That's a little bit double.
Correct.
What do you think, Mukesh?
So I think this is an interesting case. When you say that the Indian company is performing DEMPI functions, I presume that it's performing, part of the DEMPI functions and not the entire range of DEMPI functions. So let's assume that the Indian company is a contract R&D service provider to the Malta company or to the Netherlands company after the transfer of IP ownership. So far as the Indian company gets compensated on an arm's length basis, there is no challenge. But if it is performing more elements of the DEMPI function beyond the contract R&D, you will need to follow an administrative guidance. The administrative guidance in India is largely for R&D functions. Interestingly, the administrative guidance came into the law before action point 8 to 10, and it broadly talks about two things. Number one, how do you really go about characterizing an entity? And it has characterized the entity in three ways. This is largely because India is the hub for R&D centers for many Fortune 500 companies. One is a contract R&D arrangement. Second is a R&D where entrepreneurial functions are assumed by the Indian R&D unit. And third is a mezzanine form of R&D functions. The guidance lays down criteria by saying, depending on who assumes capital risk, you will characterize the R&D center. And then it also lays down some guidance that depending on how the R&D center is characterized, you will use a particular methodology. So let's say, for instance, the R&D center is a risk R&D center, significant functions are performed, capital is, risk is taken by the Indian associated enterprise, then you could subject yourself to a scenario beyond the arm's length scenario with use of profit split method. So, it will all depend on the facts of each case. The other point that I wanted to make is that post-IPO, when the Malta company sells the IP to the Netherlands company for $100 million, does India in any manner benefit from that sale? This example does not suggest so, because if India has performed DEMPI function at the pre-IPO stage for the Malta company, you could have a situation where the gain made by the Malta company by selling the IPO to the Netherlands company, a part of that gain could be taxable in India. I don't know what would be the basis for computing the taxes, but we have a several cases that deals with methods of valuation for DEMPI related cost or intangible cost. And in fact, the Sun Pharma case that Seema spoke about earlier does have stipulations on discounted cash flow basis for valuation. I don't see
And
my
how does it work then, Mukesh? How would it work if in India there are some functions being performed, the IP is carried over from Malta to the Netherlands? India could probably see and envisage that situation being not in line with real economic reality, because functions were in India were in the Netherlands. They could probably say that more functions were being performed in the Netherlands, or in India.
Well, I think if it gets picked up, it will be an afterthought by the Indian administration. And that afterthought can occur only when it sees that the IP ownership was transferred at $100 million. So I think a right way to look at it would be saying that if the Indian company is performing contract R&D and it's not assuming any risk, then to the extent the Indian company gets compensated on an arm's length basis, there should be no basis. But I think an afterthought can occur to demonstrate that the Indian company was indeed performing contract R&D and that it did not carry any risk. The risk, if any, would be if the revenue brings evidence on record that because certain DEMPI functions were being performed, which will not necessitate categorization of the R&D function in India as contract R&D, then that could occur.
Yeah. Okay, from that perspective, I can see that. Yeah.
Yeah, in the real case at hand, the pre-IPO situation was rather unclear when it comes to DEMPI. The corporate was not really familiar with the concept. So there was some technology developed in India. There was some brands protected by a legal team in the Netherlands at the level of Malta. And Malta was used as a flotation vehicle in the later IPO. So it was like clustering the various investors pre-IPO into the structure. So the IPO happened, and when the IPO happened, it was decided that the center of DEMPI would be the Netherlands. Hence, in line with perhaps the movement of the legal rights from Malta Code to the Netherlands, and India would take the role of contract R&D provider. So the other trail pre-IPO was not all that clear. If you would have done the pre-IPO DEMPI and the post-IPO DEMPI analysis, I guess that's the simple version of the truth. That would not been that easy, because that concept was not even existing pre-IPO within the corporate. It was teams working together across borders. So if we take this case and we swap to a recent case which happened in Holland, where Uber landed its intellectual property rights in a Dutch entity. So if we assume the Netherlands is now Uber Netherlands, the Malta company is replaced by Bermuda, and the India Co is replaced by the US. And if that's the case, Bermuda, similar to Malta, by the way, no people on the payroll to perform or even lead a DEMPI functional team in other jurisdictions. The value this is the increase in intellectual value Uber landed, and this is based on Bloomberg's publication, was about $6.1 billion. Take the market cap of Uber being around 80 billion. Uber makes about 40% of its revenue line outside US. So let's assume this is non-US rights. Then I have 40% of 80 billion is the value of the non-US portion of Uber is 32, of which 6.1 value is the intangible value, which was landed in the Netherlands entity. Would that change our analysis?
Steef, why? Because it's indeed that the IP non-US was carried over to the Netherlands for 32 billion.
6.1 billion dollars. Yeah.
So 6.1, that was the value carried over from Bermuda to the Netherlands.
Yeah, and just to compare it with this case, that's the 100 million in this case.
What I know from the Ipr case, nothing has been published in the Netherlands, but a lot of political people, of course, saying something about it. But what I learned from the Ipr case, on which I didn't work, but comparable cases, but in the Ipr case, there were 3,000 people working in the Netherlands dealing with IP development, etc., 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 etc. So the DEMPI functions and lawyers were also there. So the DEMPI functions were, to a certain extent, being performed from the Netherlands. And so, what's on exactly your question?
No, that's the type of analysis we should be looking for. So yeah, it does have the similar overlap with the case at hand. The main question you could ask, but obviously the US system is different. If the prior transfer DEMPI functions were performed by the US, what would be the kickback to the US, and would there be some kind of cost sharing in place, which typically was the case under various structures where US IP would be spun off from the non-US IP portion. Yeah, this is sort of where the 6.1 billion seems to be, and that's a little bit what my opening talk was about, seems to be getting closer to enterprise-wide value rather than one legally protected or protectable source code of a platform.
So there is more here. If I look at situation, I was explaining 3,000 people working in the Netherlands, and after I explained it, I thought, of course, these are the people dealing with IP development, probably fully within the US and the Netherlands. So nothing really happened in Bermuda. So to what extent will the Dutch tax administration, they will accept the landing of the IP in the Netherlands with, of course, also the depreciation consequences. However, we don't know. What I noticed from the transfer pricing case I'm currently running is about the year 2013, where the tax administration fully applies the DEMPI criteria. So I can imagine that they say, okay, fine, we have to accept the IP landing in Netherlands. However, the value, that's a different piece of cake. Since you actually seem to have developed everything in the Netherlands or in the US, but at least not in Bermuda. So they probably could go back based on Dutch law with a retroactive opening of the tax assessment. But at least a transfer price discussion seems to be something where I assume Ipr will get in.
Yeah, again, Hans, this is a Bloomberg's publication, so I need to make reservations on the accuracy of the statement. I think you're right on that. But if 6.1 billion was published, and the non-US portion, so market value of Uber, if I slice it based on sales outside US, is worth 32, then 20% is the value. The 20% of the market cap value equals that 6.1 billion. So yeah, your point is then relevant. Is that 6.1 billion, was that already being created by someone in Bermuda? No, not very likely. So the question is, who created that 6.1 billion? And maybe, again, we don't know, maybe Bermuda received that 6.1 and had a kickback to the Netherlands and had a kickback to the US for the pre-transfer Dempy developed position. But that's all in the unknown, but to be expected, unless you take a very legalistic view. You say, I get a cash flow stream from a legal owner, which doesn't have any kickbacks right now, except Bermuda might have a cost sharing with the US for the US territory, but Bermuda will, in legal terms, be the recipient of the platform fees for the rest of the world. And if I just take a very legalistic view, I just take a discounted cash flow of that future income minus some Dempy cost, and that's what my 6.1 million is all about. So potentially leading, I think that's your point, to double count.
So you're actually saying, which is right on the slide, DCF of future income minus Dempy costs could be very low, and therefore the structure in itself.
Only if I have an argument, if I'm an inspector and I have an argument.
Of course. But assume nothing really happens in Bermuda. Assume really.
That is at least what the press release said, and the case you're looking at is another stock quoted company I was visualizing on this slide, changed obviously for the confidential background, but yeah, that's sort of the whole dilemma of onshoring. Are we taking a very legalistic approach, or are we just assuming there's a cash flow coming to Bermuda, and if we want to cut Bermuda out of the chain because we believe it's maybe not so wise from an OECD or a BEPS perspective to leave Bermuda in the structure for whatever reason, by cutting out Bermuda and bringing all that cash flow into, in this case, a Dutch entity, suddenly generates very mechanically a DCF value of 6.1 billion. Any thoughts, Seema and Mukesh, on this?
Seema, you want to comment, especially on the DCF, because that was also the, Sun Pharma case as well.
So, not on the DCF as much, but, on this whole, so the Indian transfer pricing regulations are while we have a really long list of what constitutes intangibles, there is no different method for benchmarking these. You still need to do your normal FAR analyses to arrive at what is the arm's length value for the intangible. So the OECD guidelines play a reference role as far as trying to arrive at an arm's length price is concerned, but we still need to go back to the law. Now, I do know that, the OECD guidelines at para 6.42 do say that, legal ownership by itself does not confer any right. But, I really find it hard to be able to apply it in the context of Dempy or any FAR analyses to say that, you are the legal owner, but you do not have any risks. So there should not be any additional return attributable. I just feel that, legally that argument may not fly because something needs to be attributed to legal ownership. You could say that, okay, we did not perform any functions, we did not employ any assets, but to say that even by virtue of being the legal owner, there are no risks attributable, I think that's a little subjective, that judgment. And then what is an arm's length return which should be compensated to the risk of holding the title? That is anybody's guess, really.
That's an important one in the things I've been working on. I've had these discussions also, Seema. And what I always check, I had a company with an IP in Hong Kong, a Dutch company. That's always the question: was it developed there? And how do you deal with, for example, protection with all kinds of risk, etc., etc. And I remember that in that situation, that you have warranty liability claims play a role, and happily that in that specific situation, apparently the risks were incurred by that corporation, and also the functions were being developed there. But often I also see situations, I'm honest, that where there is IP in a corporation, and whenever a problem arises, it's going to be paid by a sister or parent company. And therefore, is the risk really being incurred by that offshore? And it still happens a lot. So yeah, I see them both.
Yeah, Hans, the way the OECD has phrased it, they say typically you expect on a multiple group companies owning an IP. Typically, it's the one who's charging for the IP to group companies, not co-owning it, is the legal owner. But it is expected that the legal owner then shares the proceeds with the economic co-owners, and that's, I think, the whole dilemma we're looking at here as well. And obviously, if especially the fronting desk, the legal ownership is of a nominee level, that means no people on the payroll. You get into no people almost in the area of a risk-free return on whatever the value of the asset is. I have one company buying from another chemical third-party company 3 million of assets in Malta, but there were no people on the payroll. So in my dialogue with the tax authorities, they said, oh, no people means on that 3 million, 1% seems a reasonable return for that nominee ownership.
And it could even be lower in practice.
Yeah. So this is Switzerland, who and I also see Susanne is there, has indicated that if principal companies want to remain or come to Switzerland, they can do a step up in base on intellectual property to fair market value. They call it built-in goodwill, and they might depreciate that over a 10-year period. So they might actually offset it against taxable base. The way they look at this is the building goodwill is a reflection of people and assets. So it's an enterprise-wide type of valuation, and there's a couple of valuation techniques you can actually apply where this isn't just another illustration where IP in the books with a connected to a marketing team, an R&D team, etc., with a yellow ribbon around it leads to a certain value, which can be impaired, in this case, tax-free and amortized over a longer period. Obviously, there's a big dilemma for countries like Switzerland. How do we keep the country attractive? This is one way of doing it, but you can imagine that there's different views on what will happen after the 10 years as well. So you see here tax authorities bringing certain facilities to the table, which create with the enterprise-wide valuation very attractive tax consequences for staying in Switzerland or coming to Switzerland. So this is again a reflection of an enterprise valuation, and I know we're running out of time, so we will have to pause on this. But maybe in the next plenary session we can also invite Susanna to comment on that. Or you want to say a few words, Susanna? I see you're unmuted.
Yeah, thank you. Maybe just one explanation. It's really a kind of onshoring to Switzerland, because the former principal status or principal taxation was based on a bit artificial allocation to foreign permanent establishments, and that was a tax allocation, a quite mechanic allocation of part of the profit from the Swiss principal to these other limited risk distribution entities. And because this principal status was abolished as of 2020, we now have the migration or the onshoring of these deemed PEs to Switzerland, and that's why we get the step up in the depreciation. So it has a technical basis.
Thanks very much, Suzanne. So this is another illustration where, as I said, the enterprise value, the enterprise-wide value, rather than an isolated piece of a brand or a patent, will be the base for the valuation, in this case, to onshore into Switzerland.